Welcome back for another interview. And this time we have Aurelion Research here. We have Jeremie and Leo. So it's nice to have you on here, guys. Just to introduce a little bit sort of Aurelion Research. It's sort of an independent research platform, you could say, on Substack, right? You guys sort of bridge the gap between what one might say is institutional level analysis and to sort of the retail world, and uncover high conviction opportunities in sort of the underfollowed small cap to the mid cap space, right? I think it's 50 million to 15 billion market cap.
Yes.
So yeah, can you just talk a little bit about your background and introduce and perhaps add on some additional information to what I just described?
Yeah, I can start on my end. So my name is Leo. I'm from originally from Quebec City. This is where I grew up, and I think as most people, investing, I've been passionate about markets and investing for a long time. I moved to Montreal when I was 20 years old to study finance, and then I started my career at a fund in Montreal, a small fund called Tonus Capital, which they invest in North American small caps. So, a bit where my interest in small caps started. And then I worked for about 8 months at Pembroke Management, which is another Montreal-based fund investing in global equities this time, but typically smaller companies. I was covering healthcare there, and was very lucky to work with a very amazing investor there called Martin Sekov, which helped me build my philosophy today. And then after that, I worked for a quick summer at PineStone Asset Management, which they invest typically more in larger companies. So it was different exposure than what I had. They have 80 billion in assets, so it was a different type of than these small funds.
Yeah,
And I met Jeremie, and we've been doing research now for
Yeah.
we started last year together. And so what we do on a Substack called Aurelion Research is we have equity research as well as on specific companies, as well as thematic research and micro research. And the focus that we really wanted to do is to be aligned with the people that read our reports. So every company we have a buy rating on, we'll include this company in our portfolio, and we'll track the performance of the portfolio. So this is really meant to be aligned with our viewers, and I think this is the reason why
We
we've
buy the
created-
IDs almost
Yeah.
like more than 90% of it. I own it in my own account.
Yeah. I mean, usually I assume what you write up and end up liking, it's hard to resist not buying,
Yeah.
right? So and
It's,
what
it's
about you?
different than it's different than the typical traditional equity research because they'll buy a buy rating in a company because their boss told them we're bullish on oil. At Goldman, we like oil right now.
No, they don't buy in sell side.
Exactly. So
They
they'll put a buy
can't.
rating on the company, but they won't. The analyst doesn't even buy the company because he doesn't believe it. He's been told to pitch the
It's
stock.
investment banking.
Yeah, for the fees of the investment banking. So that's why we're a bit different here, where it's very aligned with the performance, and right now we're doing great on the index.
So on my end, I have a bit of a more unconventional background than Leo. So I think me and Leo, we do a really good team because maybe Leo brings a more methodological methodology.
Perhaps institutional, sort of more what you would say finance
he's more
approach,
like
right?
more following of. Leo is more
like fundamentals and the
He focus on the more of the more qualitative, and Leo is more
and you like
quantitative.
to sort of do the idea generation part of it, right? That's how
I'm more of the. I have more idea than Leo, but Leo is. I think he has a really good track record, but on his IDs. But let's say I do more of the commodities, which I think is more not harder than others, but you can just. Let's say I would want to cover a consumer defensive tomorrow. I could learn about it and do it, but commodities you can't just try and enter, and so it's really different, I think. So My background is more, I started investing myself. I read a lot of book like Peter Lynch. I'm not
Yeah, yeah.
really, there's a lot of Buffett guys or value investors and fundamental. I'm less like this. I'm more like IDs, new IDs, and
Mm-hmm.
just trying to do the best returns. So that's my mindset. And I now I study, well, I did my studies in finance like Leo,
Mm-hmm.
and I work it a bit in a microcap fund at Rivemont in Montreal, which is a small fund but really good track return. I think this year they did like nine. Last year they did 90%, I think,
Yeah,
but
I
this
mean
year like
Matthew
30.
Martin, right?
Yeah,
If you are
Mathieu Martin
in
is good.
Canada, right? Yeah,
Yeah.
yeah, exactly.
So yeah, and I started because there's a lot of fun when you start. You They don't really listen to your IDs, and I was a bit more of a contrarian, so I was like, okay,
Mm-hmm.
why not doing it myself? So I started it, and Leo just after he liked my IDs, and he just joined, and right after, and
Mm-hmm.
now it's took shape. It yeah, it took shape, and. I think we are on the right track to push this as far as we can.
Yeah, and as far as I understand, sort of you guys' approach, it's just sort of the impression I got, and perhaps you can, add your own detail, is sort of you guys don't like to get boxed in into a particular thing, but you like to really sort of look at everything that is around, right? You do this thematic research, essentially not because you want to focus on to one's particular industry. I mean, sure, that's usually why I do a thematic research, right? But more to sort of have a broad overview of what is like happening all around sort of the market side,
Yeah,
right? To then pick out what you really like, right?
yeah. We do a lot. We go from, let's say, I would be interest in Japan.
Mm-hmm.
We won't screen all the Japanese equities, but we would say, okay, I think that from a macro perspective and market dynamics, I think that semiconductors in Japan are well positioned for the next year, like not
Mm-hmm.
10 years, like just this year maybe. We
Yeah.
enter with one stock that we think is the best, and that's one ID. And from that ID, maybe we would see that in Indonesia, this stock exchange or
Mm-hmm.
airport would see more traffic of people, and we would add another ID. And so it's really case by case with what we see, what we hear. It's not a methodological method of checking every exchange or every sector, and
Yeah.
so
Mhm.
it's really it's macro driven, but it's a bit of feeling also, and we just go
Mm.
from one sector to another. We don't really have a niche, just trying to do the best returns that we
Yeah,
can.
so
And
essentially like keeping up a sort of flow state, right? A sort of state
yeah,
where you're just like in a continuous sort of um, moment of just that's exactly what suits you, and you want to stay in that sort of part.
Yeah, but of course, what we cover, like for example, I don't know much about the Chinese market right now, and
Yeah.
there are different like specific economies by region.
Mhm.
So we won't, start looking at four stocks in that region because typically we'll try to know what's happening in that region
Yeah.
with a thematic research, for example, and then we'll pick a stock that
Mhm.
makes sense. But we're not just picking around, just every cheap
yeah,
country.
Yeah.
And but it's also, we do that, but because we're in North America, we're based in Montreal in Canada, we have more Canadian, we have more US stock than
Mhm.
anyways in another country, further away, because it's closer to our skill set. We can meet the
Yeah.
management team, we can go,
Familiarity as well, right?
yeah, we can drive off and go see their facility, so that helps. So
Mm.
it's a mix of the two, because if you're just looking everywhere for the cheapest stock, I think that's not set for doing long term returns.
Mhm.
But if you only stick to, let's say, the Canadian market, and you only pick stocks in Canada, if your goal is just to do great returns over a 3-year period, for example, or a 1-year period. Maybe Canada this year, we don't like the Canadian economy, so we're not just going to limit ourselves to Canada. We'll go to other countries, to other regions, and we don't limit ourselves as well to specific sectors. So we'll do most, healthcare, industrials, commodities. There is some that we like less. For example, biotech, like this company like that's something we don't like. We prefer to having a good mode, like a good competitive advantage to the business, because once you have that, typically there is a floor to the stock, in my opinion. Like if there's a good business that's going to make cash flow for sure for the next 10 years. You just don't know exactly the level of cash flow. There's still somewhat of a floor. But if it's a biotech or a risky, super risky tech company, then the floor is smaller. So we try to still keep those quality companies mostly.
Yeah. And you also sort of talked about visiting facilities, sort of what one might say boots on the ground research, right? So and you also emphasized these sort of high conviction ideas. So can you sort of walk us through a specific time recently where you, let's say, visited a company or management team and it sort of immediately killed the thesis, or sort of where you felt like, okay, it's just a gut feeling perhaps that this isn't what I expected to be?
Yeah,
Leo,
last year I did a
okay.
company called Texas. It's a, when you read their vice presentation and their annual report and what's online, it's a great business. And I think, if you get to know the management team, it's still a great business. But we, went there in person and talked to management. And they were announcing basically they would move offices, and that basically the whole thing was that incremental profits was going to be very high. So they already invested in their tech software, and at that point, all the new customer would be incremental profits, very high margin,
ready to go.
ready to skyrocket basically. And this is almost what the market was pricing in, because it was trading at like 30 times EBITDA. So it was pretty high, and they really needed to perform. But then when I visited in person, it was like, okay, we're going to need to move to a new, bigger headquarters, basically. So that where everyone was this headquarters. So much bigger headquarter. They were going to hire more people again, and then they would have more R&D. Like, this was announced, of course, in the press release and all that, and in earnings call. But I got more light into like exactly, and it really felt like there's no way they won't be spending a lot more in the next years on everything. And the market was pressing in these, extremely high margin expansion. So decided not to enter that one, and it kind of missed, I think, for 5 quarters in a row. But like small misses, but the guidance wasn't improved. And I think the reason why, it's really you talk to management. Of course, they don't give you anything more than what the market, but it's more about how big your answer is and what thing you kind of interpret from their answer.
Yeah, and sentiment as well.
They
Right?
would if it's a microcap.
Yeah.
But we won't say this.
And you have this Aurelion, you have like this index, right, of this basket of 10 stocks, and this one, of course, didn't fit what you guys were searching for, right? But what does it sort of take? And I mean, you don't have to, you don't have to lay out everything, right? I mean, it's your guys' approach, right? But what has it to sort of fit to get into the index, and maybe perhaps also talk a little bit about the performance and sort of how you guys manage that index, that it's sort of for the community as well. I mean, you guys have a stake, right? But it's
I
to
could
show the
say
community,
about
right?
what fit in it, and Leo could say after about the returns, maybe.
Yeah, that's great. Yeah.
Okay, so we don't have any criteria other than maybe we avoid a bit, like Leo said, biotech, or let's say I would never add ETF of crypto. But we don't have a criteria of we never buy China or economies that are really unpredictable, I would say. But usually we could buy anything that is in the range that you said at first, like 50 million to 50. 15 billion, and it could go from any country or any industry, but really looking for value. And I think our method would be that usually you find a stock, and a guy would find a stock, and what market cap doesn't matter, but he would find a stock and would be like, okay, this copper company is really nice. I think they're going to do really good, but you need the right maybe management when it's a smaller company, and you need but the most important thing for us, usually, would be the timing, because I think that's what makes the Aurelion Index so good in the returns we have so far. We almost always have a good timing. Like you some would ask, why would you keep a stock 6 months and it would go nowhere, but it doesn't happen yet in the index. We would move the stock. So usually we have a good timing, and like we entered Japan one stocks before it pick it up, and like that's what we were anticipating, that Japan would pick up. So we find good companies, and we have them in our mind, but we just pull the trigger and add it to the index when the timing is right. I think it's really a timing thing.
And out of curiosity, like, is there a reason for this sort of 50 to 15 billion market cap range? Is there like a specific reason for that?
Not too small, not too big.
Yeah, that's the one answer.
For institution, it's better, but Leo can.
But the main reason is that the larger caps, I think it's much more difficult to have an edge on and to do greater returns, especially when it's all covered by equity research. Everyone knows the thesis of the company. I think it's more of a portfolio management skill than especially like this.
And timing perhaps as well, right?
Yeah. It's more timing and portfolio management than. So I think we can do higher returns with the smaller companies, and that's why we pick those. And below 50 million for us we'll look at some of them. It's going to be maybe on a short list, but it's tough, because often it's not there's no competitive advantage. There's no moat. It's extremely volatile. They move a lot, and we prefer a company that has, proven a little bit and also the volatility is low, So depending on the size of the portfolio you have, some of these stocks are almost not traded. So we prefer
one guy sell and stock is down 20%. So
yeah. And you guys, you have covered this sort of US-Iran conflict, right? You did a few also free reports out there. I think it was on the shipping containers, right? If I recall.
Not containers, but tankers.
Oh yeah, tankers, right? And this has been sort of going on, and when you read these sort of headlines about the war and all these geopolitical risks, like I think this might be a more specific question for you, Jeremie, but essentially, how do you go from, okay, I've read this now, how do you go from now I have an idea, and then sort of, okay, this is what I want to look for? Like, how do you approach sort of that perhaps
for shipping? We have two companies that are in the index currently. We didn't change anything with them. We still hold them. Some people, I think you could see it on the headline or on Twitter, on X now, but you would see that a lot of people are really surprised that shipping rates of tankers, like to keep it simple, every day one ship, the big boat, would earn 100K US per day while he's on the trip. That would be the spot price. So this spot price rose really, really high. It was already high, but right? With Iran, because they cut it's longer trips, and other routes that you take. So but the surprising thing is that a lot of shipping stocks are down actually. So every rates are up, like really really up, but every stocks this week is down. So
Yeah.
from our side, I was kind of not expecting it, but
Yeah.
I was
Surprised, perhaps.
I
Yeah.
was a bit surprised, but I'm not that surprised about it because usually in shipping it's really really weird of a market. You can't just, there's some guys they just enter shipping and they get burned and they just left and they never go again, and this
'Cause that's shipping is a bit like crypto. You
Yeah.
enter when every shipping is hot. You hear about
Yeah.
shipping, people buy shipping, and then the smart money gets out. People that really knows the cycles, they get out, and then you get burned on it. So most people that know shipping and tankers, they got burned typically.
Yeah. Very
that
very
don't know.
cyclical business. Oh.
You need to be a shipping expert,
Yeah.
to be honest. And right now, I think there's more room for upside for the tankers specifically. I would avoid containers because containers not a good outlook going forward. A lot of fund are shorted, and I won't short it, but I would say that it's not the best place to be. So let's say currently we are in product tankers and we are in oil tankers. I think this week is a good opportunity. It's still cheap, but for Iran and the oil prices, we did our piece kind of covered oil and tankers because usually they are linking, but you could have a higher oil price and it wouldn't change the what tanker earns, so it doesn't really matter. And so far I don't know how oil is Brent crude. It as is at
92, I think, right now.
92.
Yeah.
Oh,
I mean, you can
it's
search up,
not.
right?
No, no,
I'm
no,
also
no.
shocked by the.
Oh,
Was 90, I think, this morning. 92
Yeah.
now. Okay.
Yeah. Yeah. I
93.
think I saw it like a few minutes ago. Yeah.
93. Oh,
Yeah.
fuck. Oh, sorry. And so for oil, okay, so quick analysis.
Yeah.
So we were projecting like every Morgan Stanley and JP Morgan were like, oh, okay, $80 a barrel, or like bearish, and like they are always are bearish, but we were like, okay, maybe 85, max 100. Because every time you would see a guy say 150 oil coming, it never happens.
Yeah.
Like it
The
takes
oil
more than
bulls.
this.
Yeah.
But I think it can push easily to 100. But after this, it's hard to know because you never know when the strikes will end up. It's a weekly analysis basis.
Yeah, and it's also hard to predict. Oil is a very news-driven commodity. It's more that than
It's news, but
yeah,
it's back before this happened in Iran.
yeah,
A lot of people think about oil as a demand and supply story, but I'm not thinking this way. I would say it's more of a demand destruction story. So when you
yeah,
saw oil a couple of years ago, it was at 140, I think, and it went all the way back to 60. I was short oil,
yeah.
and a lot of people were like, what's happening, and
Yeah,
why would it go down like this? But the consumer wasn't really going to pay $2. Well, here it's $2, but
yeah,
the price was too high and there was demand destruction. So now it's a bit different.
Nowadays, you can buy an electric car. There's so many ways to avoid it, and if the oil
yeah.
price
Substitution effect, right?
backs up to a super high price, people will just substitute to
Yeah,
something
but you
else.
Yeah,
need oil for the new car, so it's not really.
Yeah, and so you guys also wrote about the sell-off in SaaS, right? Software as a service, because of we Cloud Core work and all of these new plugins recently. So how do you look at sort of these markets and perhaps determine, okay, this might be one that is let's say structurally affected by it, or one that is not, and thus also offers maybe something that is compelling for you guys like to think in sort of the 3-year term, as far as I understand, 3 to 5 years. So sort of in that kind of a
Time frame.
time zone, time frame.
I think the answer on this is pretty boring, but it's you have to look at company per
Boring
company.
is good.
Yeah, but it's boring, but it's I think it's the answer is it's a
It's
company.
boring, but it's sexy, Leo.
Yeah.
And investors like to put everything in the same basket, and if AI comes in, all SaaS is bad, so I sell all the SaaS. I think this is completely fair. And also, people have been knowing this for a long time, that AI is getting better.
Yeah.
It's not because Claude has Anthropic has a new AI model that suddenly SaaS needs to go down 20%. I think that's ridiculous. I think that should have been priced in a long time. But I think the answer for investors is you look on a company per company basis. If the company is a smaller, kind of like newer tech company that is not mission critical, it's a light service that you have on top, and it could be replaced by, for example, an agent AI, then of course this makes sense to go down. But if you look at bigger companies that are mission critical, like like this key buzzwords that people like to use, but if it's really critical to the business and it's entrenched basically into the offering of the business, I'm thinking like ACP, for example, and these larger softwares, I think they're going to benefit from AI, because there's no way you're going to replace the software by AI. Who's going
and they
to
can also integrate it to some
Yeah.
extent as well.
Yeah, exactly. I think it's going to take so much time until AI becomes, people actually 100% trust AI, where they're going to be, okay, I'll replace completely this mission critical software like ACP, for example, by AI. Like, this will take time. Not only you need the technology to be as good as the current software and the human that looks at it. We also needs the confidence, which is going to take a lot of even more time. I think confidence to be like, okay, let's have this complete AI running this, charging my clients, for example.
Yeah. I mean, now it sounds absurd, right? Maybe in 15 years it changes. We will see that.
Yeah, but
yeah,
people need to. You don't forget that in for softwares, there's a lot. They say, people say SaaS, but it's not always SaaS. So there's like CAAS, there's a USaaS, there's CSaaS. There's a lot of different subsectors, and they can't all be disrupt. Some are actually good with AI, or can do better because they are integrating
it.
yeah AI. Like, we have a stock that we really like. We are public about it. It's Celebrite, and it's a Israel company that can well, they do a lot of things. But when Trump got shot, they took the cell phone of the guy, and they cracked it in 30 minutes. So Apple is one of the hardest thing to crack, and they cracked it like this, made like this. So so this one AI can just help their software
accelerate,
and they are. It's called forensic investigation tools. So AI is not a big thing for them. You don't have an AI that would just steal what they do. It would just help it.
And when you go to court, you need the process, and you need the exact like manual. How did that piece of evidence got found, basically?
And
so you can't go to a judge and say, "Hey, my AI says this guy killed."
Yeah.
Like there's no way this is going to hold
that's a
in
good
court.
point
Yeah,
because
the binding time
Regulation, right? A big
it
factor as well.
holds in courts.
Yeah.
I mean, maybe it's in 50 years.
especially for Celebrite, the stock, the company, a lot of most police station, FBI, CIA use it. So it's like a Bloomberg. You won't come
Mhm.
one day and say to the newbie that work at a police station and is 50 years old,
Yeah.
okay, today you're going to use AI disruptor 20
Yeah.
minutes.
Yeah.
He's been using Celebrite for 20 years. You think he would
Yeah.
change right away like this?
Yeah.
No, he
Yeah.
would just
Exactly.
Celebrite will integrate some AI and he would
Yeah.
say, "Oh,
Some
it will be
partnership, and
faster."
that's
Yeah,
exactly.
Yeah.
exactly.
So
Yeah.
it's some there's a lot of good companies that you can pick in the software currently, and you really need to be careful because I think a lot of them won't survive,
Yeah.
sadly, but or not. But
Mhm.
I think we are best positioned for this. We have
Mhm.
two softwares in the index currently.
Yeah, I mean, you can mention them as well, perhaps. Like what are those names? At least for the index, or
It's Celebrite and
yeah,
Ring
Celebrate. Yeah,
Central.
yeah.
Ring Central is like it's more like you have a business and you want to do it's like a Zoom but more integrated and more.
Mm,
But they actually now they use AI a lot more, and it's
mm.
just better for their services. So it's a good thing for them.
Yeah, an improvement. Yeah, or an evolution of the product, essentially. Yeah,
Yeah.
and sort of looking what's out there with all these thematic researches. What are some of the sectors you find perhaps that are perhaps perceived as boring, or let's say unsexy, right? So,
Bentley
but there
or
are yeah, like sentiment wise, right, that are perceived as sort of not interesting. I mean, we know this moves in cycle. In 2 years, that's same sector might be, everybody will want to have their money in there, right? So what are some of those sectors that at least currently you might perceive as by the market underappreciated,
you
perhaps?
would say boring or hated or both?
Both. They can be both, right? it's,
Leo
it's
can
not
talk
mutual.
about
Yeah.
cannabis maybe.
Yeah.
Yeah, I mean, in general, I think cannabis is one, but the broader consumer defensive, which cannabis might be out of that portion, but
Yeah.
consumer defensive, I think could be a interesting play in 2026 because many of the, I mean, I think right now the funds in North America are at the lowest cash reserve that they've have
Mm.
since like the 1980s.
Yeah, we saw the BOFA fund manager survey, right? I think it was 2.5%, which is
Mhm.
well below historical averages.
So the first when you think of that, you're like, okay, it's bullish. People have low
Mhm.
cash, but the other side and what's been shown in history typically is that there's no more money to be that much to be put out in those
Mm.
big stocks. So the incremental money they can put in to sustain the bull run of all the large companies, I think is lower, and I think that's going to
Mm.
be tougher. So defensive, especially in the small cap, I think are clearly underlooked right now. And we have great names in the index that have great profitability. And if the market goes down, these
Mm.
guys don't do anything. But I think it's going to be the money flow that's going to go away from some of these bigger companies that are trading at ridiculous valuations. That some of them don't benefit from AI. Some are even hurted by AI.
Yeah.
Uh, so I think defensive small cap North America is a great play to be in.
I
Mhm.
have a good example for this.
Yeah.
We don't cover it yet because it's dropping, but we're
Mhm.
watching it. And
Yeah.
it's a thrift store company that owns like 400 thrift stores, but for thrift stores for poorly
Mm.
people usually. So
Mm.
it's donation clothing and stuff, and they resell it cheap, but it's almost all profits. So
Yeah.
the outlook of analysts for this sector and all the consumer like this is that the consumer is weak and it's expecting to have less and less money. But the sectors, the companies like this, the more the consumer is weak, the better, because they fall
Thrifting
in the
becomes
bracket of
popular.
the people that go there.
Yeah, and the
So
pool.
I think the market is wrong on this, wrong on this one, and I think that it could be a good opportunity.
And just sort of also one question, when you look at management, right, you place as far as I can see a big value towards management, right? So what are some of the traits, or let's say what is the number one trait you want to see in a CEO? Just like if the best CEO you can imagine, what does he have to have, sort of trait wise?
I think the most important is you deliver on what you promise. I think
The
this is
guidance.
important. Yeah, well, not necessarily the guidance on a 1 year time frame. Of course, that's good, but on a longer period, like it doesn't have to be an exact number, but just when you appear in front of investors, extremely confident that this is what your business is going to do because that's your certain positioning. Like if you should, that's what should happen, and if you're wrong twice, three, four times in a row, there's two reasons. It's either you're too bullish, and then now I don't trust your targets,
Or the
or either
execution.
you're not that skilled in your business and I should try to pick another business.
You can't
So
deliver. You can't
yeah, so
deliver.
I think the track record and what you say historically is very important. And that's kind of tough to exactly know. It's not like written out on their investor presentation,
Yeah,
that you really
exactly.
have to look back. You really have to check out in a call, listen to the whole call, like 5 years ago, 6 years ago, see what people are saying in the previous companies. And often something cool is to meet people in the industry that are going to be kind of working with this management team or working with this company, and they can really tell you like, these guys are set to continue growing, or it's a tough space at the moment. So I think not accountability, because they can kind of say whatever and you just have to trust them, but it's more like you say something, it's going to happen, because that you can really track them on what they say.
And if I can add something, I think
Sure.
the smaller the company is, the more important the CEO is.
Management.
But
Of
it's
course,
not
yeah.
only the CEO. It would be like the top three management, like CEO, CFO,
Yeah,
whatever you
CEO.
want. Yeah.
Yeah.
Because when you have a company of like 30 billions that does chemicals, you can
Yeah.
put me as CEO and the top guys below, and it won't change that much.
Yeah. Yeah.
But if it's
At
a
least,
micro cap of 50 million in Canada that does cannabis, and you have a guy that doesn't even know what guidance he will put, maybe you don't
yeah,
have.
and you have maybe 10 workers, 15 workers,
Yeah.
20. Yeah, so yeah, every manpower is then it changes, right? And there comes a lot of things with it, sort of knowledge within a company and all of it. And you sort of already talked about sort of execution risk, and I want to sort of bring it back to the macro level. So what are some of perhaps risks for 2026 that you perceive that are perhaps not talked enough about? Or yeah.
Oh, that's a good question.
Yeah.
So from macro, I would say every year is a new year, or every quarter is a new quarter. So you
Yeah.
always need to look a bit at the big macro picture.
Yeah.
But I sometimes we have a lot of different techniques, but let's say in Latin America there would be election in Colombia.
Yeah.
We would look at this one in particular because election are coming. So in 2026 you have big elections in Brazil, and you have big election in Colombia. In Japan, you have a new prime minister that not sure if it's going to help them or not. So I think there's a lot of macro things going on, and with but we are in an area of a lot of geopolitical
Geopolitical
risk.
risk, yeah,
Yeah.
yeah.
So it's more of keeping an eye on a bit of everything than trying to guess what's next.
And perhaps Leo, do you have to add something to that, or do you like
What
see?
to
Yeah,
avoid? Oh, sorry.
Yeah.
I'm just generally conscious of the market, especially in the US. With just for today example, the S&P is down 1.15%. Job report was printed that the
It
US
looked good.
lost a lot
Yeah.
of jobs. Yeah.
Oil
So
is up.
yeah, what is up? But unemployment is getting higher, and I think I would be just generally cautious of the thing that AI is replacing jobs. I don't think it's this year we're going to see mass layoffs.
Yeah, I saw like 5% was last year
I
to
don't think
that.
yeah, but I think it's going to be more of more of a silent way where you're the company, because I talk to people that they run companies, and what they do right now is that instead of firing people, they'll keep the person and continue to train them and make it move up the ranks, but they just won't hire as much as analysts out of school.
There's
So I
less
think
interns.
Yeah.
yeah,
Yeah. Unfortunately.
there's
Yeah.
analysts, less beginners in most of the corporate white collar jobs. So I think this is an issue, especially after because right now you have credit cards debt that's all time high. People finish their 4-year degree, they have extremely high student loans, rent is high, and then now they come out, they start their university, and they have no job, or they have a job that pays a very small amount because these white collar jobs at entry levels are getting very tough. So I think that's where unemployment is going to be difficult for this year, and I don't think the market are pricing that much of a high unemployment for this year. So I'm cautious on the general economy, and I think the way to do is to diversify into small caps on an individual basis, because small caps, many of them are trading at low multiples right now. You're buying good businesses on the cheap in many regions, still in the US too. So that's my move. I'm diversifying away from the big indexes like the S&P 500 to the small.
I don't think we have any stocks in it. Do we, Leo?
No.
No. But I
Well,
would say
yeah.
I would say more inflation continuing into 2026. Consumer, it depends where you are, but you
Yeah.
shouldn't get better. But maybe maybe in Canada it could be better than in the US, but it's really hard to say.
Yeah, of course.
And we are
Especially,
early in the
yeah.
year, so
Yeah, exactly. And as we're sort of coming towards the end of our interview, are there sort of things you want to mention or highlight, or just general things? Yeah.
Yeah, I think, well, you asked before on the index, and we didn't have time to finish that up. So because we have some questions about exactly how we do it, and so I can maybe explain simply. It's when we have a buy rating in a company, we'll expressively say it in the report and say this company we think is gonna perform well, and we're adding this company to the Aurelion Index. And so every company in our portfolio, which we call the Aurelion Index, is equally weighted. And so if we have 10 companies, it's 10%. Now we're at 15 companies. And so basically it's in or it's out. And we don't have any minimum, any maximum amount of companies. So it's basically only our high conviction stocks. And
there's no
yeah,
profit taken. It's
yeah,
like you
exactly.
can't cut half.
It's to show our readers, for example, if we like this stock, well, we talk about it. It's in the index, and when we say we don't like it, well, it's out of the index, and so
Yeah.
people can track how good we are at doing stocks. And now it's been launched on July 1st, 2025, and we're up 112% in those last 8
Congrats.
months. So the performance
Thanks.
been good, and we invite anyone to go check it out for we have more disclosures on it and exactly how we calculate everything in there.
Yeah, well, thank you for the opportunity to talk with you guys. And
Hey, thank you for inviting us.
yeah, there's not a lot of young people out there doing that, right? So we need more of them, right? So appreciate it, and it was great to sort of get your guys' view on things and how you think about the markets, as everybody has sort of their own perspective, their own view. Right? Yeah,
big week, and then so much is happening in 2026. I think there's going to be a lot more that's going to continue.
Volatility, yeah.
Yeah, I have a prediction. Next week is going to be green.
50-50. Yeah. Okay. Well, cheers, guys.
Cheers.